If you're serious about building wealth through property, then you need to avoid this scam that so many people fall for. A few years ago, a friend of mine bought a $700,000 property in an area he thought he knew well. 5 years later, it was worth just $715,000. Meanwhile, in other areas, that same $700,000 had grown to over $1 million. He lost more than $300,000 in 5 years of his life. I've been investing now for 23 years, and for the last 9 years, I've been helping people avoid mistakes just like this. On average, our clients have made over $100,000 in growth in just their first year alone. And the truth is, buying a property that looks good on the surface, that isn't enough. You need to check the right things before you even think about signing a contract. Because if you don't, you could fall into a trap that wastes years of your life and costs you hundreds of thousands of dollars. So in this episode, I'm going to walk you through the 5 essential checks you need to do before you buy, why missing them could easily lead to you being scammed, and how doing them properly can set you up for real wealth. Now, before we dive into the exact checks you should be doing, let's deal with the biggest mistake most people make when buying a property. They think buying in an area they already know or finding a house that looks good and is in a nice condition, that's enough. Well, as in the story I just shared, my friend, let's call his name Gary, bought a property for $700,000 in an area he and his wife were familiar with. 5 years later, that property is only worth around $715,000, while other properties that also cost $700,000 at the same time he bought, but in different areas, they're now worth over $1 million. That gap is real money lost and time you can't get back. The truth is, you don't start with the property, you start with the fundamentals of the area. If the area isn't set up for growth, it doesn't matter how nice the house looks. You're not going to get the results you want. So don't just jump into property searches on like realestate.com.au or some other free tool without first doing the groundwork. Start by checking the data that drives growth. So let's have a look at the 5 checks you need to do before you buy. And number 1, it's owner-occupier demand versus investor-heavy demand. I see a lot of people assume that if lots of other investors are buying, their friends, lots of people online are talking about an area, that means it's a good area to buy in. Now, it can be sometimes, but not always, because areas dominated by investors can turn quickly and cause prices to either stall or worse, nosedive. Let's take the Darwin market, for example. Right now, it is one of the hottest markets in the country. Prices are rising rapidly, but it's always been a bit of a boom and bust market. One of our current clients actually grew up in Darwin, and he remembers how in the past, prices have risen and people got very, very excited about Darwin being the next big thing. But the problem has always been very little owner-occupier demand from owner-occupiers. No disrespect to anyone living in Darwin, but it's not an area most people really aspire to live in. So whenever the key project that's driving the area comes to an end or investors start selling out, it creates a domino effect and prices can fall very quickly. It's essentially like building your financial future on a deck of cards. So instead of then focusing on where other investors are buying, maybe your friends, maybe your families, no. Instead, focus on where owner-occupiers are buying. Owner-occupiers, people who buy to live in an area, put down roots and stay long-term. This creates stable long-term demand and supports capital growth. Owner-occupiers, they also buy on an emotional basis. They want their home, and often price, that's not always the primary consideration. This is what drives prices up, both in the short term, especially if there's an influx of maybe first home buyers or just owner occupiers in general, and certainly over the long term. It's a safer way to invest. While if you buy in pockets which are investor heavy, so lots of investors buying in that area, you're almost always going to end up competing for the same pool of tenants. And what does that mean? Getting your property rented could prove difficult. We're seeing that in parts of Melbourne right now. Lots of investors buying there, but not enough tenants. So it's taking longer for people to get their properties rented. And then what happens if something like what happened in 2022 happens again and interest rates start to rise? Investors can and often will sell their investment properties when cash flow starts to bite. Now what happens? You got a flood of properties on the market and prices nosedive. So instead of wondering where other people are investing or investor hotspots, don't go there. Instead, focus on owner-occupier demand. Ask local agents. Of your last 10 sales, how many were to owner-occupiers? Ask them who is their typical buyer right now. Walk the streets on weekends. Look at, are families moving in? Are there renovations happening? Is there a sense of a pride of place? Because if that's the case, these are all good things. And there are so many other checks you can do. And look, if you want a full breakdown of these checks, we've put them together in a simple guide called Don't Invest in Australia Without Checking This. You can grab it totally for free. The link's in the description below. Number 2, rental demand and low vacancy rate. Here's what so many people get wrong. They assume their property will rent because it's an area they think they know. That has to be one of the worst mistakes you can make. You can't assume. You need to be checking the data. Otherwise, you could easily end up buying something in an area where there isn't enough rental demand. That means you have long periods of vacancy, and that's going to eat away at your cash flow and probably cause you to lose a lot of sleep. For example, someone reached out to me recently. They'd bought an investment property in a pocket of Melbourne where prices were under $700,000. Now, they'd bought there because some family members who had seen in the 6 p.m. news that Melbourne was booming, they had told them, look, it's in the news, it must be right, Melbourne prices are rising, buy in Melbourne. Okay, only one problem. It took him nearly 8 weeks or 2 months to get a tenant. And he had to drop his rent significantly from what he thought he was going to get just to get a tenant, right? That is not the outcome you want. On the flip side, if you buy in an area with strong rental demand, that will help you get your property rented more quickly. And in many cases, your rents will rise as well over time, which of course will help with your cash flow. So what can you do? Check the vacancy rate for the area. Visit rental inspection open homes to see how many people are turning up. Speak to local agents about how many tenant applications they're getting for each property. What percentage of their properties are vacant right now? Yes, you check the data, and as I said, that's where you start. But then you need to be on the ground, checking out what's happening. That is the only way you can be confident about rental demand. And ultimately, rental demand, that's what will give you peace of mind when you look to buy an investment property. Number 3, selling momentum and buyer competition. Most people, they focus on what's happened to prices so far, and they ignore what's actually happening on the ground. I see so many people assume that if prices haven't risen in an area, well, then maybe that's a good time to buy. And if prices have already risen in an area, then maybe they have missed out. Maybe it's not a good idea to buy. They forget that what's happened in the past is no indicator of what's likely to happen in the future. If it was, the Perth market would never have boomed. After all, between 2010 and 2021, the Perth market grew 1% in total over 11 years. But since 2021, prices have doubled in some parts of Perth. What about Townsville in regional Queensland? Another market that was flat for like 15 years. But then it started to grow, and now prices have doubled in some parts of Townsville, if not even more so, in just the last few years. Or what about Sydney? The median price in Sydney has risen a whopping 97% in the last 10 years. And yet, as anyone who lives in Sydney will tell you, prices seem to be almost bulletproof in Sydney. They just keep rising. Or what about one more example? Let's look at Brisbane. Prices have risen over 50% in recent times. And yet, the latest data from Cotality tells us that Brisbane is still one of our fastest growing markets. So then the question is, if what's happened in the past, whether prices have grown or whether they haven't, is not the determining factor of future growth, what is? Well, there are two simple telltale signs. Number one, sales momentum. Are properties selling faster today than they were 12 months ago? Because if that's the case, that can only be for one reason: more demand from buyers than available properties for sale. There's no other explanation as to why properties will be selling more quickly today than they were 12 months ago. Secondly, look at competition. Are there multiple offers being made on each property? Or if there are auctions, are there multiple bidders at the auctions? Because again, if that's the case, that's only happening because there's more demand from buyers than available properties. And whenever you have more buyers than available properties, you have more demand than supply, which creates the pressure that pushes prices up. That's as simple as I can make it. So look at areas where properties are selling more quickly today than 12 months ago, where there are more buyers than available properties for sale. Because if that's the case, then prices will rise in those areas regardless of whether they have risen in the past or not. Number 4, economic strength and diversity. I'm seeing more people make this mistake in 2025 than I have in the last 10 years. More and more people are betting on a one industry town because the numbers look hot. Right now, I'm getting so many questions like, Nero, what do you think about Emerald in Queensland? How's Port Augusta in South Australia? What about Broken Hill in New South Wales? Kalgoorlie in WA? Yes, I know these areas are cheaper than others. Yes, their rental returns look very, very enticing. And yes, prices are rising. Now, many first-time investors will say, that's the perfect trifecta. That's fine, but I certainly wouldn't recommend buying there. Why? Because these are primarily single industry towns. That industry is mining as well. Now, what happens when there is an inevitable mining downturn? Almost every industry goes through a downturn at some point in time. Mining in particular, well, that's one of the more volatile industries. And we've seen this happen in the past, right? Places like Kalgoorlie or Newman in WA at one point were investor darlings, investor hotspots, prices rising, massive cash flow from high rental returns. And what happened? When the mining downturn came, prices dropped 50% or more in some cases, and rents dropped nearly 80%. It was a case of blood in the streets, and many investors couldn't even sell their properties to pay off their loans. Yes, their properties ended up being worse than the debt they had secured against the property. It is, without doubt, the absolute worst case scenario for any investor, and someone buying in these areas right now, they're playing with fire, in my opinion. They're taking a risk that they could end up in that very same situation, even though they don't need to. So instead, look at areas that have multiple industries, or as I like to say, economic diversity. When you have jobs being created in multiple different industries, health, education, government services, logistics, light industries, technology, tourism, the list goes on. Well, when there's multiple industries creating jobs, that lowers risk in the area. It also, over the long term, creates more jobs, brings in more people, and keeps demand strong, which gives you more capital growth over the long term. So yes, economic diversity and a growing economy actually lowers risk and increases gain over the long term. So make sure you're buying in an area that has at least 3 or 4 different major job creating industries, not just a single anchor. And that brings us to number 5, infrastructure investment. Now, here's what most people get wrong. They focus on what infrastructure creates jobs. Now, while that might be good, that isn't enough. Like I said earlier, you want jobs in multiple different industries. So look for infrastructure projects across multiple industries, but also look at what I like to call livability-based infrastructure. For example, schools, parks, shopping centers, aquatic centers, etc. Anything that will make it more attractive for people to want to come and live in that particular area. Otherwise, you could get a lot of people come to an area for work, and sure, that will increase rents, but they won't bring their families to live there with them. That means you're not going to get that long-term owner-occupier demand, which means you won't get that long-term price growth that you're after. So to reiterate, you're looking for two types of projects: job creating infrastructure, hospitals, universities, business parks, transport hubs. These bring people in for work, but then what causes them to bring their families in are livability infrastructure, schools, shops, parks, transport upgrades. These make people choose the suburb and stay long term, which boosts owner-occupier demand. So look at projects across both these different types of infrastructure, but make sure they're fully funded or underway. Do not look at projects that are proposed or promised. I'm sure I don't need to tell you why you don't want to bet your financial future on the promises of a politician. Now, if you feel like this is a lot and you'd like help applying this to your own situation, so choosing the right area, choosing the right property, and making sure you don't miss out on years of growth, then you can book a free call with a member of my team. We'll walk you through the whole process step by step. You can book a call using the link in the description below. So now you know the essential checks you need to make before buying any property. But once you've done these checks, the next question is, which properties should you be actually buying right now? Well, that's exactly what I cover in this next video, where I break down the best properties to buy before the end of 2025. It'll show you where the biggest opportunities are today and how to get in before that window closes. Click here to watch it now.